Hello, this is Tim Congdon, Chairman of the Institute of International Monetary Research at the University of Buckingham. This again is an update, a monthly update on monetary trends in the main economies. I'm talking at the end of May 2018. Now there could hardly be a more basic question in economic analysis than what will the inflation rate be 2 years from now? Will it be higher or lower than it is today? And that's the question that I want to address today, looking at the main economies. On Monday early this week, 21st of May, I attended a panel session organised by the Council for the Study of Financial Innovation, CSFI, organised by Andrew Hilton, which reviewed the attitudes and forecasts of 8 economists. Now, you might be rather sceptical that having 8 economists talking together would get you very far, and my verdict was indeed that we didn't get very far. But what was very clear was that most of the economists present at that 8-person panel session thought inflation was rising and that central banks should be raising interest rates to fend off these upward pressures on inflation. The presentation I'm going to give you today will be with a very different message, and I'm going to be using, as I always use, the monetary approach to the determination of increases in nominal GDP, the rate of inflation, and so on. And what I'm going to do is I'm going to look at the 6 largest economies in the world. They vary a bit, of course, but we'll see there are some consistent themes. And then I'm going to draw conclusions. And I'm going to say that inflation will be lower in early 2020 than today, and that this general rush towards higher interest rates, towards, if you wish, policy normalization, because interest rates have been very low for some years, is not very clearly justified by the information I'm going to be presenting. Now, I'm going to, as always, check my charts, talk about different countries and so on, starting off with America. And you can see here that just gets the groundwork sorted, that there is a relationship in the medium and long run between the rate of change in the quantity of money and the rate of increase in nominal GDP. If the trend rate of growth of real output is fairly stable, then there's also a relationship in the medium and long run between the rate of change in the quantity of money and the rate of inflation. So if we see a deceleration in the rate of growth of the quantity of money, I always look at broadly defined money, which includes all money balances. If we see deceleration in that, we should be expecting inflation in the next few quarters, the next few years, to be on a downward rather than upward trend. There may be some exceptions to this, but that's a pretty good, rather crude generalization. And what you can see as far as America is concerned is that, we just ignore the left-hand part of this chart with the huge instability, with the Great Recession and so on. Since then, there has been roughly constant growth of quantity of money at around about 4 or 5% a year, which has been associated with stable growth of demand and output and very low inflation. You can see at the end that that pattern continues, but apart from the very last month, when there's actually a slight blip up in the 3-month annualized growth rate, the 3-month annualized growth rate, the green line, actually had been trending down. I've argued in my work, and I had a video a couple of months ago about this, that the Federal Reserve is acting in such a way at the moment that the rate of money growth is likely to keep on falling in 2018. In particular, it's selling off the assets acquired in the QE programs from 2009 to 2014. So, the conclusion on America is money growth is falling. Look at the Eurozone. Here it's much clearer. Again, the last month wasn't too bad, but if we go back 6 months, even 9 months, you can see, looking at the red annualized 3-month growth rate, that that's gone down from about 5% to about 2%, and that's ahead of the ending of asset purchases by the ECB in September, which actually should cause that red line to fall even further. I talked about the Eurozone in the video last month. All I would say on this front is, in my view, the Eurozone situation is worrying and indicates a slowdown in money growth that's going to intensify in the next few months. Japan. Now, one point to notice here is that the axes on this chart are somewhat different from other. You'll see that it tops up at 10%, whereas the one for the Eurozone topped up at left-hand axis 20%, and also for America 20%. There's been very low growth of money in Japan for many years. That continues. Again, there's been a blip upwards in the last month, but the 3-month annualized growth rate, that red line, had been tending down really for 6 months or so, up until February, March this year. And finally, about the UK, the smallest of the developed economies that we look at. The red line is the annual rate of growth of money, broad money, M4X as it is in the UK case. The green line is the annualized rate of growth in the last 3 months. You can see they're both falling away at the end. Okay? So we've got, when we look at the 4 developed economies, we can see a trend towards slower money growth, which I would expect to become more pronounced in the Eurozone case, probably in the American case. The UK is having been relatively strong for a period, is also joining that. I think, in fact, because the banks are being asked to have more capital. The message, therefore, is actually that inflation will be weaker 2 years from now than it is today. All right. Now, what about the 2 big developing economies? Look at China. Well, you can see the red line, the annual rate of growth, has been slipping away, coming down from fantastic rates of growth of 20-30% back in the early years of the 21st century, today down to under 10%. And if anything, that deceleration continues, even though it's not that pronounced. India. India is the only country in the survey I'm currently carrying out where there is some signs of money growth increasing. So let's bring all this together in a sort of synoptic table, which you can see here. We've got what I've got here, by the way, is some figures in the left-hand side of the table showing the relative importance of these various economies to world output. There are 2 ways of doing this. One is to look at the so-called purchasing power parity of the incomes that people have in these various countries. The point is that a haircut in India or China is much cheaper than in America, so that if one just simply looks at the value of GDP, current prices, current exchange rates, you tend to undervalue the importance of China and India, and that's corrected in these purchasing power parity numbers. Now, we're talking about economies that in purchasing power parity terms account for about 60% of world output, in current price exchange rate terms about 70% of world output, so we're talking getting on for the world. Okay. You can see then on the right-hand side of the table, we've got the numbers that I've just been reviewing, the different countries brought together in one table. And the point I want to make here is that the growth rates in the last 3 months, assuming that they go on for a year, the 3-month annualized growth rates are lower than the actual 12-month growth rate for all of America, the Eurozone and the UK, and in the Japanese case, they're roughly the same. This argues against a rise in inflation. it argues that there is no need for a major tightening of monetary policy, but all the newspaper discussion is of a tightening of monetary policy, policy normalization, and so on. And so indeed are the announcements from the central banks themselves. What sort of growth rate of money is needed to deliver an inflation rate, say, of 1 or 2%, which is what is the current objective of monetary policy making in most countries? Well, let's take it that the ratio of money to GDP is fairly stable. Ratio of money may rise a little bit, but then what we really need in America, trend growth of output, say 2.5% a year, in the Eurozone, Japan and the UK, where it's not much more than 1% a year, we want money growth of about 4 or 5% a year. As I say, we've had numbers rather like that in America, the Eurozone, UK, and so on in the last 5 years. To be specific, the figure in the Eurozone has been 4%, in the USA it's been 4.2%, in the UK it's been 5%, Japan it's been a bit lower, it's been 3%. It's interesting, by the way, that in the UK inflation's been the highest of this group of countries, not dramatically so, but it's been the highest. And in Japan, they've had worries about continuing deflation. Actually, they've had the lowest inflation, this group of countries. Exactly what you would expect if the underlying theory that I've been talking about, the quantity theory of money, if it were correct. Now, just then return to this overview, this synoptic table of these numbers. Just reiterate what I've been saying about the developed economies. There's a slowdown in money growth, which implies a deceleration in inflation. Developing economies, China, India, they changed the view a bit, but not very much. And can I just say, the Indian economy is included here. It's very important in terms of purchasing power parity, but not that important in terms of current price exchange, but same important, in fact, as the UK, because it's got such a closed economy. High import tariffs, it's got exchange controls, and so it's nothing like as important, in fact, to world trade and world finance as China is. Anyway, if we bring that all together, my verdict is that the other members of the panel with me on Monday, 21st of May, meeting organised by CSFI, that they're wrong. There won't be a rise in inflation in the next 2 years, and all this enthusiasm for higher interest rates isn't justified. Let's then just sort of try and make this a little bit more specific. At the moment, there has been quite a big rise in oil prices in the last 6-9 months, up from kind of $45 a barrel up towards $80 a barrel. That will be pushing up the headline increases in consumer prices across the main economies, across all economies indeed, in the next 3-6 months. And that will still be, in the backward-looking, 12-month increases in consumer price indices in early 2019. So it's quite likely indeed that the inflation number in that sense will actually be higher than it has been in early 2018. Okay, I concede that. But much of this does reflect unusual events in the oil market. For example, the reimposition of sanctions on Iran by the American government and the collapse in oil output in Venezuela with the chaotic Maduro government, whose country is disintegrating. So when we look ahead in the 12 months beyond that through to early 2020, it's unlikely that that kind of oil price shock will be repeated. That will then dampen down the increase in prices in that year from spring 2019 to spring 2020. And on the view I've given about the slowdown in money growth, underlying non-energy inflation pressures will remain weak too. So I'm going to make a forecast that the increase in consumer prices 12 months looking backwards in early 2020 will be lower than in spring 2019 and probably lower than today. I don't deny that inflation, obviously it consists of increases in prices, increases in wages and so on. Prices are determined by supply and demand in product markets, in good markets, and wages, increase in wages by supply and demand in the labour market. Okay. On this basis, I would say further that in order to keep inflation down, consistent with these money trends, there's going to be beneath trend growth of demand and output in the main developed economies over the next few quarters and probably through 2019 as well, although it depends on money trends at the time. In this sort of context, I would expect asset price movements to be rather sluggish, so rather muted markets for equity markets and commercial property markets. And contrary to what's currently very much the standard view, the macro environment argues against big increases in bond yields, even though bond yields remain unusually low by long-run past standards. Thank you very much.